Welcome to the Hurst Trading Room for the 14th of January 2013. It has been a really interesting week in the markets as the US markets seem to be diverging a little bit from one another, and the euro to US dollar has kicked up and given us a very profitable long trading opportunity, and the British pound to US dollar continues to run in profit in a short position. So it's been a really interesting time. Before we take a look at the markets, please make sure that you have read and understood these disclaimers. And let's take a look, first of all, at the S&P 500. Now, last week I spoke about how I was standing by to enter an F category short trade in the S&P 500, and in fact nothing has changed in terms of the S&P 500. My default analysis that Sentient Trader is giving me has returned to the analysis that I was speaking about last week, which places the 20-week cycle trough back here on the 16th of November and a 40-day cycle trough towards the end of December. So that's 40 days over there. Our trading sequence, or our sequence of FLD and price interactions, still remains fairly clear. A, B, C, D here as the price crossed down below the FLD, and then E, an FLD and price interaction that unfortunately we couldn't profit from because, of course, we were taking a holiday on the 1st of January 2013, but that turned out to be a very profitable opportunity. The E category trading opportunity as price bounced back up above the FLD, and we're still expecting next, or I am still expecting next, an F category short trade as price breaks down below that FLD. Now, this is the default analysis that Sentient Trader is now providing me with, and so the additional chart that I created last week to basically present me with this analysis is no longer necessary, but there has been some interesting divergence in the analyses between the S&P 500 and the Nasdaq, and in the detailed video about the Nasdaq I go into quite a lot of detail about it, but let me just give you a little bit of background before you take a look at that detailed video. Let's zoom all the way out here, and I'll show you what's happening. This analysis, as you can see, implies that the 18-month cycle trough has not yet occurred. Here's the nest of lows for the 18-month cycle trough, and so we're still expecting the market to come down into the 18-month cycle trough. And this analysis implies, of course, that the 54-month cycle trough occurred in March of 2009, although we're not showing it on this chart because there isn't enough data. But you can see the very rough cycle shapes of the 18-month cycles that have made up this 54-month cycle. Here's the first one. It is very bullish. Here's the second one, and it is much less bullish. It's little better really than a neutral cycle shape, which is of course exactly what we expect out of the second 18-month cycle of a 54-month cycle. But now here is this third 18-month cycle, and it's coming up to a peak. That peak in September might be surpassed over the next few days, in which case we'd be drawing the peak to the later peak over there. But the big question that people were asking this week is, did the 18-month cycle trough occur in November of 2012? Now, it seems very unlikely, in my opinion, to have occurred in the S&P 500. It is possible that it occurred in the Nasdaq. So in the detailed video about the Nasdaq, we consider that possibility very seriously. But there's a very big problem if that 18-month cycle trough did occur in November, and that has to do with the cycle shape. Can you see that cycle shape that I've drawn there? It is a bullish cycle shape because it has a late peak. There's the peak over there, and it has a much higher trough, of course, than the starting trough. So that's a bullish cycle shape, and the sequence of cycle shapes for any 54-month cycle, there's the 54-month cycle, should be bullish, and then neutral, or certainly less bullish, and then bearish. I need to qualify my B's. There we go, bullish, neutral, and then bearish. And this has not been a bearish cycle. So that introduces a cycle conundrum, which I discuss in detail in the detailed video about the Nasdaq. And but it's worth mentioning here because it's something to consider. Now, that is if the 18-month cycle did occur. Of course, I believe that the 18-month cycle has not yet occurred, which means that if I clear that, it means that, of course, I'm expecting the market to come down and form the 18-month cycle trough in the next few months. And in that case, these cycle shapes still could make sense, even if we go to a higher peak at this point. They could still make sense if we get a strong move down over the next few months. So that is a warning, if you like, because if this analysis does turn out to be the true one and not the alternate analysis that I discuss in the detailed Nasdaq video, if this analysis does turn out to be the true one, then we need to be very careful. We need to be on high alert for the market to fall hard and fast into this 18-month cycle trough in order to complete this cyclic picture. There is an alternate analysis which I discuss in the Nasdaq video, which does not carry quite such an immediate bearish warning, although it does also carry a bearish warning. Take a look at that video to really understand that in detail. It is also a bearish analysis, but over a slightly longer time period, and indicates that we might get a bit more of a rise out of the markets before they turn down. But because of this longer term outlook at the moment, I am certainly standing by to enter into a short category F trade. And so let's just zoom in and have a look at that. Again, of course, the F category short trade would be entered at the level of the 20-day FLD. And so there is that FLD. I'm watching that FLD and standing by to enter a short trade at the level of that FLD. And if the bearish picture that I've just shown you in the longer term picture turns out to be true, then we can expect that F category short trade to be a very profitable one. Let's take a quick look at the Nasdaq. In the Nasdaq, we can much more easily conceive of an alternate analysis. First of all, this is still my preferred analysis in the Nasdaq, and as you can see, it positions a 20-week cycle trough over here in the middle of November, and a Sentient Trader has positioned an 80-day cycle trough over here at the end of 2012. I think that's the 31st of December 2012. So that's an 80-day cycle. So that's a difference between the Nasdaq analysis and the S&P 500 analysis. Now, according to this analysis, of course, the trade that we missed out on because it was New Year's Day was an A category trade, and we are expecting a B category short trade next, which is a trade that I would not enter. However, and I explain this in much greater detail in the detailed Nasdaq video, there is an alternate, which in fact, as you can see here, places the 18-month cycle trough in the middle of November. It is a viable alternate, so there we have it, 18-month cycle trough. If the 18-month cycle trough should be in the middle of November, then the trade that we're looking at taking next in the Nasdaq is also an F category short trade, exactly the same as the S&P 500. How do we resolve these analysis dilemmas? As you know, there's a very simple process that we use, and that is that we reduce our risk. So I think an F category short trade is most probably going to be the next trade that we will take in both the S&P 500 and the Nasdaq. I will be reducing my position size in the Nasdaq because of the subtle analysis uncertainty that is happening there. As a matter of interest, these two analyses have slightly different FLD levels, and so I will be taking the safer level which is a little bit lower than this one, which is on the other chart. So that's the story with the Nasdaq. Let's take a look at the euro to US dollar. I published a quick update in the euro to US dollar last week on Thursday morning. I must admit I didn't expect the euro to kick up so strongly, which it did on Thursday. It suddenly boosted itself up and crossed our entry level, the level of the 20-day FLD, as you can see later on Thursday. So this was our entry price for that trade over here. As you know from that video, I expect that this is an A category long trade because I believe that this trough here is a trough of the 80-day cycle. You can see that this actual analysis differs ever so slightly, but in its basic elements, it is the analysis that I believe is taking place. That's the 40-day cycle trough over there. This is the 20-week cycle trough over there, and 80-day here. So we're in a long A category trade. Our T1 target was hit the next day on Friday, so we exited from our first trade at a profit. On Friday night, as the day's trading closed, the T2 level was adjusted slightly downwards to over here. And the reason for that I explain in the detailed video about the euro to US dollar. It has to do with the level at which the median price actually crossed the FLD as opposed to the actual price at the moment that it happened. So our T2 target was brought down slightly, and you can see that in fact earlier today our T2 target was taken out. So we exited from our trade 2 also for a profit, and our stop loss on our remaining trade 3 has been raised up to the level of our entry price. Here it is over here. So it's a break-even exit on our trade 3. So that means that the worst that can happen to trade 3 is it exits at the level that it entered for a break-even, no profit, no loss. And that means that this trading opportunity has already proved to be a profitable trading opportunity because we have locked in the profits from trade 1 and trade 2. Now, there are alternate analyses that might be playing out in the euro to US dollar, and I discuss them in the detailed video. But the most likely alternate is that, in fact, the trade that we're in is not an A category long trade, but an E category long trade. Okay, and of course it makes very little difference to the actual trade itself. It has nevertheless turned out to be a profitable trade, and if this turns out to be the true analysis, then we'd be looking at an F category short trade next. I wouldn't enter an F category short trade within the next 2 or 3 days. Certainly I would give the market a little bit of room, so we have time to think about this and to work out which analysis really does look viable. But F category short trade might be the next trade. My preferred analysis, however, has us stepping aside and not taking the next short trade because it would be a B category short trade. But as we get more data, we have some time to play with here while we watch our profitable long trade unfolding, so we can make decisions about that later in the week. Let's finally look at the British pound to US dollar. And of course we're in a short trade in the British pound to US dollar. So again here we're seeing a divergence between the closely correlated instruments that we trade. The euro US dollar and the British pound to US dollar are diverging. We're in a profitable long trade in the euro US dollar and in a profitable short trade in the British pound to US dollar. That is quite unusual, and it highlights the fact that this is a slightly unusual time in the market. And we're also seeing divergence between the S&P 500 and the Dow and the Nasdaq. So it's an interesting time in the markets, but it's a very exciting time to be trading, and as long as you know what you're doing. So that's why the detailed videos this week are slightly longer than they usually are. So I hope that you have a little bit of extra time this week just to take a look at those detailed videos, particularly the one about the Nasdaq. The British pound to US dollar, as you know, we're in a profitable short F category trade. So it's an F category trade. Here is, of course, the 40-day cycle trough over there. And there was our E category interaction, and here is our F category interaction. We entered the short trade. What comes after an F category interaction? Of course, a G category interaction, and that is exactly what it looks as if though is happening at the moment. Let's just zoom in a little bit and I can show you in greater detail. An F category interaction between price and FLD means that price comes up to the FLD and then tracks along it, and that is a G category interaction, and that is exactly what it looks as if though is happening today. That is why I have not exited from our short trades. The one thing that I have done is that I have tightened my stop slightly on this trade. So let's have a look at this trade. Here is our entry price, and we exited from our T1 trade at a profit. Down here, our T2 target has not yet been hit. It's still sitting below us at 159.467, and of course when our T1 target was hit, we would have reduced or adjusted our stop loss, reduced our risk by moving our stop loss over here. If it turns out that I'm wrong and that this is not a G category FLD and price interaction, then of course price would break up strongly away from the FLD. I'm not expecting it, but if it does happen, then I want to be out of this trade. And so a sensible level to exit from this trade is at the high of last week, which is over there, which is why I have in fact moved my stop loss from the level over there all the way down to here, so that now on our remaining two trades, trade 2 and trade 3, we would take a very small loss if it turns out that this analysis is wrong. I did that first thing this morning, much earlier today, before I could see clearly that it looks as if the price is doing as you expected, and it is in fact tracking along that FLD. It's a really wonderful thing when you see price doing what you expect it to do as it approaches the FLD. The FLD is a very powerful line. The future line of demarcation works really well in terms of defining what price is doing and where it's going. And we can see an example of it playing out in real time here as price tracks along that FLD. And that's certainly what we expect. So it looks as if though this short trade in the British pound to US dollar is certainly still going very well. It's a profitable trading opportunity, and it looks as if though the F category trade might morph into an H category trade, which does fairly often happen, in which case of course we're expecting even further profits from this trade. So that concludes our look at the market. Let's take a quick look at our spreadsheet, and I can demonstrate to you on the spreadsheet what's happening. Of course, we use the spreadsheet to track what we're doing in the markets. The background to the rows indicates the sort of status of the trade. The light green and dark green rows are rows for trades that we haven't entered, trades that have either closed out or that I'm considering entering, and the blue background rows are trades that are still open, so trading opportunities that we're in and the trades are still open, and the orange background rows are trades that are part of a trading opportunity that we're still involved in, so we still have an open trade, but the actual trade itself has been closed. So you can see here the euro to US dollar, the long trade that we entered last week. Our T1 and our T2 targets have been hit, and here of course is the all-important column, money. So we made $266 profit out of our trade 1, and our trade 2 had a reduced target of course, but we nevertheless made $372 profit out of that. And so our trade 3, the worst that could happen to our trade 3 is that it's a break even. So we make no money out of it at all, but we also lose no money. That's the worst that could happen. If the market keeps moving in our favor, then we'll implement our 3-bar trailing stop and start making some more money out of our trade 3. But the total there, of course, is $638. So that's a nice profit to make in only a few days on that profitable trade in the euro to US dollar. Our British pound to US dollar short trade has been a slower trade. Here's the detail over here. Our T1 target has given us a profit of $200, and our T2, our trade 2 and our trade 3 are both still open. So we haven't taken any profit out of them yet. As you know, I've adjusted the stop, and so you can see I've adjusted that stop to provide a loss of only $44. So the worst that can happen in this trading opportunity is that the market turns against us. It doesn't look as if though it's going to, but it might. If it does, then we'll lose no more than $90 from our trade 2 and trade 3 together. So we will have exited from this trading opportunity at a profit, despite the fact that it would have turned out to be a trading opportunity that hasn't gone our way. But at the moment, there's absolutely no reason to think it's not going our way. It is going our way, and so it's a profitable trading opportunity that is still in progress. So as you can see, some good figures in our spreadsheet there. Please take the time, if you can, to take a look at the detailed videos in the trading room this week, because there are some very important analysis considerations, I believe, that it will be useful for you to get your heads around in terms of what might be happening in the US markets at the moment. I also think that the US markets are vulnerable to a really strong fall, so you need to make sure that you've got your analysis sorted out in case that happens soon. So if you can, please take a look at the detailed videos. If you have any questions or any comments, then please pop them into the comment box below this video, and I look forward to seeing you next week in the Hurst trading room, if not before. And in the meantime, profitable trading.